let's jump right into the number one strategy that we have for capital gains tax planning. And I want to point out here, there are a number of strategies in this space, right? If you go onto our site, and I'll show you this in a little bit, and you go through our guided planning tools, and you tell us that you're just planning for capital gains, selling your Apple stock or your cryptocurrency or your startup equity, there are several strategies that might apply. There are certain other kinds of trusts. There are exchange funds. There are opportunity zones. Why are we focusing on charitable remainder trusts? Simple. And the answer is that the returns are highest given basic assumptions about your life and what you need out of this. And they're also, in general, the most flexible and fit the needs of our clients the best. We can talk more about that. You can ask questions, or we can always talk to you individually about whether this is a fit for you. But our experience is that even when we present many of these possibilities, our clients overwhelmingly come back to the CRUT because of the features that I'm going to describe here. So what is it? I put right there in highlighted text, it's a tax-exempt account. That is, bottom line, the number one feature of these trusts and why most people choose them. What happens, and I'll explain this in depth, is you take an asset, and throughout, I'll be talking about appreciated assets. It could be anything. It could be your public company stock, Apple, Netflix, some random penny stock that's gone up in value. It could be cryptocurrency. It could be your startup equity, an angel investment you made, real estate, collectibles, anything that's appreciated in value. If you put it into a charitable remainder trust and then sell it, you're going to pay no tax when you sell. And that is the fundamental feature of these trusts. You'd rather not pay that tax on day one, and you'd rather keep more of your money to reinvest and compound and grow, as we've already said. It's an uncapped account. We like to say that a CRUT is a lot like an IRA, which I'm sure you're all familiar with. Just like an IRA that grows tax-free for a long time, a CRUT does the same. An important feature here that is worth noting, and we get the question a lot, is, are there any limits? And the answer is no. We have clients who've put $200,000 into a CRUT. In fact, even more than that, we have some clients who have put in $80,000. That might not be ROI positive, might not have a positive return on investment, but people have chosen to do it. And we have CRUTs that are as large as $400 million. It is an uncapped account, and it's going to be tax exempt for a long time, no matter how much you put in. You're going to get annual distributions, and so this is in many ways more flexible than your traditional tax exempt and retirement accounts. You get to pull money out of the trust over time, and you get to give a little portion of that money to charity. We'll talk about this in more depth. We'll show you some numbers, but an important principle before we get into it is that there is a charitable component here, but that's not the driving feature. This isn't only a charitable vehicle. This isn't only for people who want to give a lot to charity. That is how the CRUTs were used and were described for a long time, really until Valor came around, or maybe a few years before. These were a tool for retirees who wanted to give a bunch to charity and have an annuity or some income in the meantime. But while that's a nice feature, we'll show you the numbers, and these things are super positive return on investment, even ignoring the charitable piece. That's a bonus.
I have a question there, Jeff. Can you choose the charity, for example?
Yeah, this is a really important piece. Although, again, the charity isn't the driving force. It is important to a lot of people where that money is going, and the answer is you can choose the charity. As long as it's a registered U.S. nonprofit or a family foundation, or really usefully, it could be a donor-advised fund. I'm not sure if everyone's familiar with DAFs, but the idea is you can put the funds into this fund, this donor-advised fund, which you control. You can invest that money and grow it and give out to charity over time. Importantly, you can also sometimes pay yourself or your beneficiaries to manage that DAF. But most importantly, you get to take your time and give that money out over time, which is a really useful feature. There are a couple of questions. We'll go into depth here, but just very quickly, this is an important guiding principle. Yasir asks, can you go standard deduction, married filing jointly, with 29K? The deduction that you're talking about, the standard deduction, is a small part of how a CRUT works. And we'll talk about this. There's a little bit of a deduction, but this is completely separate from the normal adjusted gross income deduction situation. You are putting the assets into a trust that is completely separate from you. The trust becomes the owner, and it is tax exempt. So when you sell the assets, it won't pay any tax. Doesn't matter what you're doing on the personal side.